Good day. This is Dr. Terra here, and we're going to work on the statement of cash flow today and how to do a statement of cash flow indirect method. So here's the problem. It reads in 2017 and 2016, balance sheets of Gibson Corporation follows. The 27 income statement is also provided. Gibson had no non-cash investing and financing transactions during 2017. During the year, the company sold equipment for $15,200. This will be important since it's cash flowing out, and the statement of cash flow is about the flow of actual cash flowing in and flowing out of the company. The $15,200, which had originally cost $12,800, that's the equipment, and had a book value of $11,300 on its $12,800 original cost. The company did not have any notes payable during the year, but did issue common stock for $31,000. Okay, the company purchased paint assets and long-term investments with cash. Now remember the statement of cash flows. I use a mnemonic. I call it OIL. O-I-L, oil. All right. Well, oil is Texas is known for, so I think the OIL is kind of a good mnemonic, but it's not quite oil. It's really, we have to change that L to an F. And what that stands for is operating activities, investing activities, and financing activities. So those are the three activities that take place in a company, and we have to look at the cash that is flowing in and out in order to do a statement of cash flows. So first, we need to take the statement and give it a name. So this would be Gibson Corp. All right, and this is going to be the statement, and I'm going to use CF for cash flow, and it's the indirect method. And this is for the year ended December 31st, 2017. So it's the current year that we're doing the statement of cash flows. So the first thing that we want to do is we want to look at the cash flows from operating activities. The oil, operating activities. All right. Well, where do we start? Well, we have to first look at the income statement here and the balance sheet statement. And what we're doing is we really want to drop to the bottom line, the net income. And I'm going to highlight it. All right. So this is the income statement. This is the income statement, and this is the net income. The other thing that I want to highlight is I want to highlight in the balance sheet. It's the comparative balance sheet, meaning between the prior year and the current year, right? And what I want to do is I want to look at cash, and it's the cash in the current year. And what the statement of cash flow is going to do is going to reconcile the net income, okay, for the end of the year, right, to the end of the cash balance in the balance sheet. All right. So those two numbers I'm going to highlight, and I'm going to come back to the statement of cash flows. And in the statement of cash flows, I'm going to start with the net income. So we're going to start here with the net income, which is $182,400 from the income statement. The other thing I'm going to do is I'm going to come now to the bottom, and I'm going to come here and I'm going to say the cash end of the year. End of the year. And that was on the balance sheet, and that was $48,500. Okay? So that was the cash at the end of the year. So we put the net income, and we have the cash at the end of the year from the balance sheet. So this was from the income statement, and this was from the balance sheet. Right, end of the year balance sheet. And what we're going to do now is we're going to look at operating activities, investment activities, and financing activities for the company for the year, and we've got to reconcile. All right. Well, the next place I want to do is I want to go back to the balance sheet. Okay, I'm going to go back to the balance sheet, and I'm going to look at the cash from the ending of the prior year, $20,500. And remember that in the balance sheet, the ending of 2016 becomes the beginning cash of 2017. So let's go back now to the statement of cash flows. And let's put the cash at the beginning of the year, right, which was the prior year's ending cash, and that was $20,500. Right. Now, if I take the cash at the end of the year, which is $48,500, and I subtract the cash at the beginning of the year, that difference is $28,000. That's $28,000 I'm going to put here. And what that is in this case, is the net increase, in cash. Net increase in cash. Right? It's net increase in cash. So what that means is that this number here is, in a certain sense, a check digit. Because when we add up all of the cash flows from the operating activities, the investment activities, and the financing activities, those three numbers should add up to the $28,000. So it's a kind of a check digit, and in a certain sense is, I think, kind of an easy way to back out into knowing what the numbers that we're going to put up for these activities are going to be. So next, let's go back and look at the financial statements. First, let's look at the income statements. There's two numbers that we want to look for in the income statement. One is depreciation expense. So the depreciation expense is a calculation that really isn't cash. And in the income statement, you subtract that expense from the cash income, right? So it's not going to be cash. So what has to happen is we have to add it back. We are going to have to add this back, this $25,000. This $4,700 in income, depreciation expense, back to the statement of cash flows. Okay, sorry folks, I'm not quite sure what happened there. I'm assuming we're still recording and we'll have to edit this all out before it went blank. So we talked about the depreciation expense. We went back to the income statement and we looked at depreciation expense, and depreciation expense is not a cash activity. It's a calculation that's subtracted from the income, so we have to add it back on the statement of cash flow, the $4,700 right here. All right. The next thing we want to look at is the gain, a gain or a loss, and in this case it's a gain. And what happens is this, again, is not a cash transaction. This is a calculation, and this is a gain of $3,900, right? And that actually was added to the income, but in reality, that's not cash flowing in. So we're going to have to subtract that out in the statement of cash flows. So let's go back to our statement of cash flows. And let's put the depreciation expense, and that depreciation expense was $4,700, and we're going to add it back. All right, and then we have to look at the gain or loss, but in this case it's a gain on the sale of equipment, and that gain, which was added back in the income statement, needs to be subtracted from the statement of cash flows. Those things you're just going to need to understand is depreciation expense is always going to be added back in the statement, in your statement of cash flows. A gain is always subtracted from your statement of cash flows. A loss on an item would always be added back to your statement of cash flows. All right, now let's go back and let's look at the balance sheet now. I want to look at the balance sheet. And there are some areas, and we're actually going to have to look at every one of the cash flows that happen for all of these accounts. We're first going to look at current assets, and then we're going to look at current liabilities. Well, current assets are here. They are the accounts receivable, the inventory, and prepaid insurance. Those are current assets. And let me give you a little roadmap. Current assets, okay, between the prior year and the current year can either go up, all right, or they can go down, right? Can either go up or they can go down. What happens in the statement of cash flows is an inverse relationship. So if the current assets go up in the statement of cash flows, the amount is going to go down, and if the current assets go down in the statement of cash flows, they're going to go up. Okay, we're now talking about looking at our current assets, and when the current assets go up in the balance sheet, in the statement of cash flows, the amount will go down, and if the current assets go down, in the statement of cash flows, it goes up. So in this case is that there was in the accounts receivable, the accounts receivable went up $2,400, right? So in the statement of cash flows, they're going to go down. Okay, we're going to now look at accounts receivable. So we go back to the balance sheet and we look at accounts receivable.
and accounts receivable is a current asset, and so the difference between 2016 and 2017 is $2,400 increase in the balance sheet. So in the statement of cash flows, it's going to decrease. So we go back, put an increase in accounts receivable. So that's going to be a decrease in the statement of cash flow of $2,400. Next, we want to look at the inventories. So we go back and we look at inventories, and when we look at the inventories in the balance sheet, we can see that the inventories have in fact decreased by $6,500. And remember, if it's a decrease in the current assets, it's increase in the statement of cash flows. So we go to the decrease in inventories, decrease in inventories, of $6,500. So it's increasing in the statement of cash flows. So that should be getting too many zeros here. $6,500. Next, we want to look at prepaid insurance. So we go back and we look at prepaid insurance, the last of the current assets, and we can see the prepaid insurance increased by $500. And so if the current assets in the balance sheet increased by $500, and prepaid insurance increased $500, it's going to decrease. It's going to decrease in the statement of cash flow. So it increased in the balance sheet, increase in prepaid. So it's going to decrease. It's going to decrease in the statement of cash flows. It's $500. Right? So now we want to look at the current liabilities. So we have these 5 accounts in the current liabilities. And remember, following the roadmap, the current liabilities increase the statement of cash flows. It's going to increase, and if in the current liabilities balance sheet, current liabilities decrease, the statement of cash flows, they're going to decrease. And so we can see here that the accounts payable decreased by $3,300, and wages payable in the balance sheet decreased by $4,900, and the interest payable increased by $2,800, and the income tax payable increased by $5,500, and the accrued payables, all current liabilities, they increased, accrued liabilities, for other accounts decreased by $3,900. So these increased, increased, and decreased in the current liabilities. So we then go to the statement of cash flows, and we look at the statement of cash flows. So we had a decrease in accounts payable in the balance sheet. So it's a decrease in the statement of cash flows. We had a decrease in wages payable, a decrease in wages payable of $4,900, so it's a decrease in the statement of cash flow by $4,900. We had an increase in the balance sheet in interest payable. These are all current liabilities of $2,800. So it's an increase in the statement of cash flows. Excuse me. We then had an increase in taxes. Tax payables of $5,500. So in the statement of cash flows, it's an increase of $5,500. And then finally we had a decrease in the balance sheet of accrued expenses payable, and that decrease was $3,900. $3,900. So remember that the depreciation expense is in the income statement. The gain in sales is the income statement. Those two, you just have to understand that if it's a gain in the income statement, it's going to be a reduction in the statement of cash flows. Depreciation expense is a deduction on the income statement. It's an increase in the statement of cash flows. You then have to look at the current liabilities. So these are the current liabilities right here, current liabilities. And remember the road map with the current liabilities, the change in the balance sheet goes up, then the statement of cash flows goes down. And if the current, these are current assets. I apologize, current assets. If the current assets go down, the statement in cash flows go up. These here, the accounts, the payables. So all of the payable accounts right here, these are current liabilities. So in the current liabilities, if the change in the balance sheet, current liabilities go up in the statement of cash flows, the amount goes up. And if the current liabilities go down, the statement of cash flows, the amount goes down. When we total all of these up, these are going to be the total adjustments, reconciling adjustments. It's going to be $600. Then the total net cash provided hold on. Okay. So the net cash provided by operating activities is going to be 600 plus the 182,400 that came from the income statement. Remember, that's from the income statement. These are all from the balance sheets. That total is going to be $183,000. Okay, so remember our oil, OIL, except this is really F. So the operation portion provided is 183,000. We next have to look at cash flow from investing activity. So we want to look at cash flows from investing activities. So if we look at the problem here, it tells us that they sold equipment for $15,200. So remember, investing activities have to do with property, plant, and equipment, PP&E, and so proceeds from the sale, so this is sale of equipment, was $15,200. $15,200. So the cash flow from investing activity is property, plant, and equipment. Sale of equipment, $15,200, which comes from right here in the problem where it says $15,200 sold for equipment. We also look at the problem, and we have to look at the purchase of equipment. Well, the purchase of equipment, we have to go back to the for the purchase of equipment, we go back to the balance sheet and we look at go back to the balance sheet and we look at property, plant, and equipment, and we can see the property, plant, and equipment current is $151,000, and the previous it was $134,000. So that means it increased by $17,000. We also go back and we look at this $12,800, which is at an original price of $12,800, which has been totally depreciated by now. And so that amount for property, plant, and equipment becomes $29,800. We go to the statement of cash flow for the purchase of equipment. Because you purchase equipment, that means it's a cash flow out. So it's going to be negative $29,800 flows out. Right? Then the last thing we have to do with purchase, plant, and equipment is the purchase of stock investment. So we have to go back to the balance sheet and we look at investments. Investments, you can see in the previous year was zero, and it grew by $110,000. So that means they purchased investments in stock of $110,000. So we have to put the purchase of stock, right? So that on the balance sheet of $110,000, because they purchased it, it's a cash flow. It's a cash flow. It's a cash flow up. So the net cash provided by investing activities is $124,000 cash flow out. So when we sum those all up, it's $124,000. So there's the I. There's the I in our oil. All right. So we now have to look at cash flows from financing activities. So we want to look at cash flows from financing activities. Well, for financing activities would be cash dividends, and if we look at cash payments for dividends, the cash payment for dividends gets to be a little bit tricky. So we have to go here, and we need to look at our income statement. Remember, first of all, let's go back to, remember I said the balance sheet? The balance sheet. The balance sheet is equal to the assets equal to liability plus the owner's equity. And I said the income statement, right, is revenue minus expenses, okay, equals the net operating income. And remember I told you the net operating income, okay, at the end of the period, flows into the retained earnings, all right, or the owner's equity. So we go and we look at the income statement and total amount on the income statement. So the total amount on the income statement is $182,400. Well, first we have to look at retained earnings. The retained earnings currently is $159,600. However, we have to take the previous amount in the balance sheet of $2,600, right? And we have to subtract it, which means the retained earnings increase by $157,000 from the previous year to the current year. We then take this amount and we subtract it from the income statement, net income. That's the net operating income right here. take the 57,000, right? And that difference is going to be 400 here, and this is going to be $25,000. So that $25,000 has to be dividends. So we go back to the statement of cash flows, and we put in dividends. Cash payment for dividends. So those cash payments for dividends, which is going to be cash payment for dividends, meaning cash going out, is $25,400. We now have to look at long-term debt. So let's go back to the balance sheet, and let's look for long-term debt. And here is long-term debt. Long-term debt in the previous year was $112,000, and it dropped down, reduced by $76,000. So long-term debt payment has got to be $36,000 that they paid off. We go back here, go long-term debt payment. From the balance sheet, there's going to be a reduction of $36,000 cash payment out. And finally, we want to look at the issuance of common stock. Issuance, common stock. And we go to the problem, and the problem says the issuance of common stock. Issue common stock. So when they issue common stock, they're bringing money in to the corporation of $31,000. So that's cash flow in the issued common stock. So if we add these three up here, that's going to be a total of a loss or cash flow out of $30,400, and that is the financing activity. We add these three up, and it should equal to the $28,000. $28,000. So these three equal the $30,400. We add out the O and the I and the F. It should equal $28,000, and we have now done the statement of cash flows. Hopefully this has been helpful.